Yesterday we started something as net, EVA. The formula for economic value statement is net operating profit after tax minus invested capital into a weighted average cost of capital. So continue the same. Let's understand what is the difference between EVA and the basic accounting profits. The accounting profits denotes the overall profitability of all, that is my production and non-productions. They indicates how the profit metrics are changed. They are asserting the overall growth. Whereas when I talk about economic value statement, it purposefully talks about the profitability or growth, and it helps me to more precisely understand how the business is progressing. When I talk about the profits, it's the outcome of my regular trading and non-trading activities. But when I talk about the economic value statement, is purely concentrate on how much profit I earn and how much profit I'm going to use it. So while calculating the EVA, we more precisely concentrate on the actual growth, whereas when you calculate the profits, we are interested more about understanding how the activity or performance overall done. So EVA is more core concept. It enables us for getting the details like how much is economic activity, how much are related activity, and so forth and so on. But when I talk about the profits, I just meant the turnover or changes happen. So in case of cost of capital, the opportunity cost and net income or earning per share, these are not valued when I talk about the profits. Only mere dividend or only mere interest is important in case of profits. But when I talk about the EVA, instead of only profits, I am more interested about how the profit is earned, what are the resources used, and so on. So accounting profit or the profit is simply understanding how much the transaction value the I have earned. But when I talk about the EVA, it consider how, when, where they are obtained. So basically, capital, weighted average cost of capital, and the purpose or source of capital is understood in what we call as economic value statement. So when you say the economic value statement, we always talks about how how much and where the capital has been used. But in case of profits, we always talks about the advantage or gain in terms of financials. The in EVA, we need the adjustments in accounting practices and integrations because the current accounting practices and integrations are not complement and enough. So while calculating EVA, we need more detailing and more information. This is an example. I'll wait for a few seconds, go through the slide, then I'll explain you. So here we have net operating profit 1 lakh, capital is 1 crore, and weighted average cost is 12%. I have not purposefully gone in the numerical where the weighted average cost of capital is required. So our formula is net operating. Let me show the. So we are using the formula net operating profit minus invested capital into WSCC. So the simple illustration I have taken. So we have net operating capital 1 lakh minus invested capital 1 crore into 12%. So 12% of 1 crore is 12,000. So we have 1 lakh minus 1 lakh 20,000 and my EV is negative. Even though I have profits, my EV is shown as negative. It means the company's values, which I'm indicating as progression, actually it is not progressive. It is actually making the loss. Why and how it is making a loss? Simply when we are calculating profits, there are some investment adjustments, there are some financial adjustments, and so on. So these all adjustments are being ignored, and we need to analyze these all activities for our profitability. So EVA is one of the tools which gives a clear picture, clear idea where we can utilize the all the aspects of productivity and tell whether business is doing good or whether the business is doing bad. So let's continue further. What are the advantages of economic value statement? This is particularly talking about much more strongly about sustainable growth. It gives a more accounting clarity since it has a broader sense of scope of application and utility. It covers the all domains which are related to production and the factors of production which is utilized because we're talking about weighted average cost of capital, we are talking about net operating profit, and we're talking about the amount invested. So the factors of production, their cost of borrowing is considered based on the investment. For example, I have preference shares, debentures, bonds, and equities. Overall, the cost is suppose 16%. Then this 16% cost is also considered as expenditure. In accounting profit methods, I have proposed dividend, but I never declare the dividend before profits. So I'm not clear what is the dividend available. But in case of EVA, my importance is given regarding how much profit is available and when and why. So when I calculate EVA, I understood what the actual performance I had done. But when I calculate the profit, I just understand at the end of financial year what is my achievement. Now, this theoretical part I'll purposely ignore because it is not required. Let's go to the core part. What are limitations or challenges using EVA? EVA involves first weighted average cost of capital, net operating profit. So it is more complex than the simple net profit. It required some additional efforts, additional points for operating profits. The EVA is more precise and more important, but the relative application in global level is less because there are other indicators like cost management and etc. These indicators are used for analyzing the performance. So EVA is not one of the tools, but it is the traditional tool, and there are more modern techniques like we have Douche point, caramel technique, and ECG. So it is a traditional, it is complex and not easy to calculate. Then while calculating the EVA, we have something called as average cost of capital. Here the skills of analysis, what is average cost of capital is essential or crucial. So in that case, it becomes a complex situation. It becomes an absolute limitation that how to deal with it and how to propose and evaluated things, the risk assessment. Secondly, the EVA is not interested to promote investments in innovation because it talks about the productivity. When you're doing investment innovations, the payoffs are generated in starting period as negative because these innovations are yet to marketize or capitalize in better way. So these innovations are initially negatives. Secondly, in initial phase of launching, the people awareness about the product, its utility and gains are limited. So in that case, the product is not generating cash cow. Then they, if not generating cash cow, the operational efficiency of that product is limited. And once the operational efficiency is limited, what we suffer a challenge that the EVA becomes negative. Similarly, if a company is holding the intangible assets and these intangible assets has a major portion in non-current assets. The valuation of these intangible assets is again a doubtful question because EVA advocates the valuation of intangible assets based on productivity. Patents, copyrights, these can be valued on productivity, but the goodwills is a major intangible asset which cannot be directly valued in terms of productivity. So the limitation of same is not answered in economic value statement. So when you talk about the economic value statement, we have the advantage of clear picture about profitability, productivity, and sustainability, but we have limitation about complexity, manipulation risk, ignoring research and innovation, and it is involved poor contribution of intangible asset valuations. So this is consider the slide which talks about where we can apply. So I can apply the economic value statement to the asset heavy industries, that is mostly the manufacturing, because in manufacturing I have multiple domains, multiple sources, and the chain of operation is large. Secondly, the companies which are already established having standardized accounting or economic policies or SOPs, that is standard operating procedures, they are very efficient to utilize the EVA. Whereas in case the startup or the companies which just has begun the business and yet to set the procedures or yet to go in turnaround or yet to set the SOPs, that is standard operating procedures, they have not enough competent to apply for the EVA. Secondly, the companies who are in expansion phase, going with the restructuring or having a lot of expenses over research and development, they are not having effective use of EVA because even though they use the EVA, the application has limitations because the EVA will not give the correct figures. R&D is capitalized based on the returns, but initial phases there are no returns, only expenses are shown. So only expenses may lead to negative EVA, and this negative EVA may create an impact the company is not growing, and so they are not suited for sale. So most of the time, startups, small companies, heavy R&D, it is suggested not to go with the EVA, where the companies which are large scale, heavily having manufacturing facilities, transportations, and capital investments, where the companies have standard SOPs, they are very effectively can utilize EVA. So these are the examples where we can apply and where we cannot. I'll wait few seconds. Please go through this. If any doubt, question chat box because I already discussed this. So when I talk about applicability, the most applicable part in EVA is manufacturing sector, and where they're most not applied is technical startups and the companies which are just has a smaller or average capital. The companies which are more service oriented, or where the SOPs are not followed. They are based on the project basis, like IT companies or technical service companies. The EVA has limited application. The companies or retail businesses where the intangible assets and moderate capital requirements are there, their application of EVA is limited. Availability of fixed assets, availability of inventory, and SOP is a major relevant where I can apply EVA. I'll come to this how to maximize latter phase. Uh, Now let's understand some basic numericals of EVA. So I'm switching to the numerical part and then we'll come to the application part. So this is the book prints which I have done. I have my own book on advanced financial management. So from the following information of an IT company, we require to calculate the economic value added statement. So what data we have? We have years that is 22, 21, 20. So we started from 2020 to 2022. EBIT that is earning before interest and tax is in lakhs. Non-branded income is this. Inflation percentage given. Remuneration of capital is 5% average capital employed. Then average capital employed is 1450. Corporate tax is 30% and capitalization factor is 15%. So out of the following information, what is the formula of EVA? Let me just write it down. I'll just change the font and the location. So the formula is net operating profit minus capital invested into average cost of capital. So when we're solving this numerical, I required net operating profit. So I got EBIT, I have non-branded income to adjust, then the average cost of capital and tax rate because earning before interest and tax is given. So I need to adjust the tax rate and capital. Then additional information what they are given 12% debt is for 2000 crores and equity capital is 100 crores. Reserve surplus is 7500. Risk-free rate is 9%. Beta is 1.05%. Market rate is 19%. And equity market premium is. Anybody remember the formula for weighted average cost of capital? The first information what they have shared, this block they are using for EVA, and the second information is for WACC. And this way, the numerical is divided into two formats or two factors. So please go through the numerical. I'll just erase all the things. Since first numerical, it is very crucial for me to understand everybody the basics. I'll wait few seconds. Please read the numerical. So I hope the reading part is done, not to waste much time. So let's talk about the solution. The first, we have to find out weighted average cost of capital. We have earnings for interest and tax, 7,50,000 minus 60,000 because non-branded. We have to adjust the inflation 8%, compounding factor of 1%. So present value of profit is 690. How I done 690? 750 minus 60. I got by adjusting this the 690 as my value. Or if I illustrate here, 280 was my earning before interest and tax. I have non-branded 15,000. So 280 minus 15, the adjusted profit becomes 2,65,000. The inflation compounding factor was 1.2142 and the inflation was 11%. So what I done, the amount is 265 and I have inflation of 11%. So I need to find out the amount that is 265 into 1.242. So the answer is 2 point, sorry, 3,249,143. Let me just show you the calculator also. Now I'm using the screen sharing. Yes. Now calculator also visible to you. I'll just show you the calculation part. When it is 5,25,000, so I have to adjust the non-branded income 45,000. So let's do it. It's 5 to 5 minus 45. So my answer is 480. So after deducting the non-branded income, my answer will be 80. There is inflation of 15% and inflation compounding factor is 1.08. So now I need to multiply this amount by interest compounding factor, that is into 1.08. My answer is 518.4. So when I apply the interest compounding factor, now what is interest compounding factor? This interest compounding factor is nothing but application of inflation. Because when I started the company, that time the prices were different and now the prices has different. So when I apply 1.08, what I get is present value of profits. Then I need to assign the weightage. So I assign the weight 2. So here 518.4 is multiplied by 2. My answer is 1036.8, and this is my weighted profit. Please read the numerical, see the calculator, and if any doubt, post in chat box. I'll again show the working for one more year. But time being, just analyze what I done. If you want, I can just scroll the numerical so that all these factors are clear to you. They are given the inflation at 8%, 15%, 11%. So when inflation is given in examinations, they normally provide you the compounding factor. If the compounding factor is not given, I'll teach you how to calculate the same. So let's work out for the other part. We have earning before profits for the 2020 is 2,80,000. Then I have 15,000, 15 lakhs, which is non-branded. So my adjusted profit is 2,65,000. So here 2,65,000 into inflation, that is 1.242. So into 1.242, my answer will be 329.13. Since the weightage is given 1, my weighted cost of capital is 329 and this. I hope it is done. So let me show you interest compounding factor. I'm just sharing the table which is normally followed for same. In our numerical, which we are discussing, we have the inflation 8%, 15%, and 11%. So please remember same. So the these are the values. So 8%, we have the value 1.10 for the 1 year. 11%, we have 1.28, and 15%, we have the value of 1.38. So this is compounded interest values. If we scroll down, the values are going to change based on the figures. So these values are available in log table, and you can refer the log table at the time of examination. But we are thankful to the Pune University. They don't make our numericals so complex. They go with uh, detailed formulas, and they will provide you the numbers. But if numbers are not provided, please remember in our numerical, if it is 8, it is 1.126. So when it was 8, it is showing compound factor 1, 15 1.08, and for 11 1.21. So same you will see in this table. So if you see the 8, 8 is 1.020. So it is less than 1.5. So it is assumed to be 1. In case of 11, we have to find out for the 2 years. So we'll go to the down and find the second table for 11%, 15% for the third year, and so forth and so on. So when I'm calculating the compounding factors, I need to take in consideration how the things are working. There are methods the compounding factors are found or done. If you remember the formula which we have used while solving the capital budgeting. So let's again go back to our numerical. When we are solving the present value, we have a formula that is compound interest is equal to 1 divided by P into R by 100 bracket raised to n. Sorry, it is not P, it is 1. So if I want to find out the inflation of 8%, then risk-free rate of return is 9. So what I'll do is 1 divided by 1 plus the returns divided by 100 and the years. Now, when I'm finding the, suppose this is timeline, when I'm finding the value of future cash flow in current year, we follow the negative compounding. But when we are finding, sorry, we are doing positive compounding, that time my formula is it is equal to 1 plus R divided by 100 and power is to n. This formula which we followed for 1 divided is find when we are finding the current value in future, which is negative. But the future value in current, if you go in backward, it is always a positive. And that's why things are worked out. And then we have the present value profits 690 after adjusting 1, 518.4 after adjusting 1.08, and 329.13 after adjusting 1.242. So let's go to the other stage. Now we have calculated the 572.655, that is approximate 573 as weighted cost of capital. Now, how we have done this? In this case, we have the weight, we have the profits. So after applying weights, we have 2070 plus 1036.8 plus we have 329.30. So it becomes 3435.19, and this we have to divide by total weights. So our answer is 572. Let me show you the calculation on screen. I have 2070, the first weighted profit, plus 1036.8 plus 329.13. So this is my average weighted profits, sorry, total weighted profits. If I to find the average, then I need to make a combine of weights. So 3 plus 2 plus 1. I'll make the combination of this. So total is 16, sorry, 6. So I divide this value by 6, and my average weighted profit is 572.65. I'll give some minutes. If you want to work out yourself, please do the working on your mobile. So I hope there is no doubt about weighted average cost of capital. So next step is EVA. So now we have to find out the average cost of capital employed and the EVA. We have net operating profits, that is 2100. Now, how the value of 2100 is appeared? The 12% debt is, we calculate 8.4%. The cost of debt, we have find out 19.5. So to greatly explain this, let me again go to the numerical. So please read these details because I'm going to explain you now how these things are worked out. So I hope the reading part is done. So let me show you the calculation step by step. It's taking some time to open the Word file. So be there. Yes. Now I'll just share you the Word file so that the answer of net operating profit is clear to your side. So I hope the Word file is visible. Oh, sorry, I not shared it. Is it visible to you? Uh, Please reply in chat box. Is it readable condition?
Yes, sir.
Thank you. So we have calculated weighted average cost of capital, but for calculating of economic value added, we require to first find out the weighted average capital. So we have find out. Now we have to find out net operating profit after tax. But in this problem, the net operating profit is already given as 2,100 crores. So the first task is finished that NOPT is available. Now let's talk about the second part. Let's calculate the cost of debt. Cost of debt is a percentage which is applied in the given numerical. They have given the 30% tax. So I have returns on debt is 12%. So the debts will get 12% returns. Let me start the screen sharing so that I can show you the calculation part on calculator. So let me start the calculator also. Yes. So we have this weighted average cost of capital. I have 12% debts, but on 12%, the tax rate is 30%. So I have to deduct 30%. So when I deduct 30%, suppose it is 100%. From 100, if I deduct 30, my returns are average 0.7 or 70%. So into 0.70 will be my answer. So cost of debt is 8.4. Please remember this value. In case of cost of equity, we have a formula that is risk-free return plus beta in bracket market rate and risk-free returns. So here we have the risk-free returns as 9% given in the numerical and beta is given 1.05, whereas market risk premium is given 10%. So I just done the working, and what I find is cost of equity as 19.5%. Let me show you these all things in numerical. We have risk returns 9%, beta 1.5%, market rate of return 19%. And they are mentioned here at the end, the tax rate is 30%. So I've taken the figures from this. So I have cost of debt as 8.4. Now cost of equity as 19.5. So let's calculate the cost of capital. Now what is nature of my capital? I have the debt 2000, equity capital 500, and reserve and surplus 7500. Again, these are the values which are mentioned in balance sheet. So let's talk about debt. If I take the total 7500 plus 500, it is 8000, plus 2000, it becomes 10,000. So I need to calculate the proportion, which I explained you already, that if it is 2 divided by 5 plus 3 divided by 4, then what we'll do is we'll write 5 into 4 as 20, then 2 into 4, that is 8, plus 3 into 5, 15. So my answer will be 23 by 20. Same thing we're doing. We have the debt, which is shown as 2000, and total is 10,000. So 2000 divided by 10,000, the weightage of debt is 0.2, weightage of equity 0.80. Now, your doubt is, sir, the equity is only 500. Why are we taking 8,000? The simple reason is the reserves which are available is associated always with equity capital holders. So 7,500 is added to the equity holders, and their total equity block is 8,000. And so I have the equity weightage 8,000 divided by 10,000, 0.8. And we calculate the weighted average cost of capital as 17.28. So the change in capital is 10,000 into 17.28 is equal to 1,728. And when you write in formula, the operating income 2,100 minus change, the total answer is 372 crores. So my final answer is my net operating profit 2,100, capital employed 10,000, weighted average cost of capital 17.28, capital charge which I calculate after multiplying the weighted average capital, and the final answer is 372. Now, since this is the first numerical, it we find tedious to understand, but please remember weighted average cost of capital, operating profits, and finding the weights. These are three crucial steps. If you can master it, you can solve these numericals very effectively. If I show you the numerical which I referred, it is the same, but it is showing the complexities. So that's all for today. Tomorrow again we solve the more numericals, and what I propose that please carry a notebook. We'll solve this simultaneously so that you will have a comfort to understand. So thank you all of you being part of this session. Tomorrow we'll meet for the AFM in the morning, and in the evening we'll meet for the finance sessions. Till then, thank you all of you. Now you can join your next scheduled sessions. Wish you wonderful day. Good day.